talked to a small cap mutual fund manager who's been doing this for 30 years and managing billions of dollars. And this guy was you've seen that chart, right? The exhalation, the panic, and
Yeah,
then
yeah, yeah,
at the
yeah.
very bottom, you throw in the towel. That's where he's at right now.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Welcome, everybody, to a new episode of the Skippy and Doogles Talk Investing Podcast. This time, only Doogles here as the host. We have two special guests who I'll introduce in a moment, but Skippy is busy gallivanting around Asia, trying to find new companies to invest in. So stuck with me. And as I mentioned, two very special guests. We got Josh Scott and Adam Burrows. Adam is the co-founder of Range Ventures, which is an early stage venture capital firm. You will also remember him if you have been a longtime listener from 2021. He was a guest here. Adam, thank you for coming back. Appreciate you as always. Adam has been an operator in his historical life. So he took a company public named Home Advisor back in the day. He started his career as a consultant, which also Josh did as well. And they both came from the University of Michigan, which is wild. So early adventures are very similar for you all. And then you both ended up at Denver, in the Denver area at one point, which we'll touch on in a moment. I'll hit on Josh Scott's intro here. Josh, also an operator. eBay, you may have heard about that. They sell Pez dispensers online. After eBay, he founded a company called Craftsy here in Denver, sold that, and now does angel investing. And as you put on your LinkedIn, a lot of learning. So we'll discuss what you've learned since then, Josh. Welcome to both of you. Thank you for being here.
Thanks for having us.
Where I'd like to start is what I mentioned before. So you both came into the Denver area when the Denver Boulder tech scene was in its infancy. I would love to get a better understanding of what was it like back then, and then we'll dive into how it's progressed. Josh, do you want to kick it off?
Sure, happy to do so. I think that the context for, let's call it 2008, 2009, 2010, that era approximately 10 years ago of Denver was like coming out of the great financial crisis, lots of what I would describe as potential energy, right? So there were people who had recognized that the places that they were working before that they thought were stable places were not so stable places. A bunch of those stable places went away. And as a result of that, and the increasing ease with which people could start companies at that time, there became a lot of company starting energy, which turned into lots of fun stuff. But it was happening at a time where there was a ton of skepticism about whether you could really build great companies in a place that wasn't called San Francisco or New York. And the way that folks were able to do that, I think largely speaking in Denver and Boulder, is the folks that did in those days brought their San Francisco and New York connections to town with them as they left those places from past elements of their career, and leveraged those relationships to help them start to build up their companies and with it to some degree the ecosystem.
Totally agree with Josh. It's felt like a ball that's just gained more and more momentum rolling downhill, right? At first, to Josh's point, there was a few people came out here, brought those San Francisco networks, starting companies. The coast then became clear for all those people's friends and contacts, and it's just gained momentum. And I think some of the millennial sensibilities have put Denver and Austin at the top of the list of the places that people want to go live for a bunch of reasons. And that's really just created a crazy amount of momentum in terms of companies starting, companies locating their second headquarters here. The talent aggregation here that we were seeing was tremendous, really in 2019, which is why we started Range. And then in COVID, like all good secular trends, that tailwind just accelerated. And we're in such an incredible place here now in the ecosystem versus where we were way back when. We're actually pretty consistently the number 5 tech ecosystem in terms of venture deals and dollars now after the top 4 coastal markets. So the secret is out.
I'd love to know what the fourth is, because I could think Silicon Valley. You got Silicon Alley, as you mentioned, that was New York. Silicon Beach down in LA.
And I don't know what Boston, I don't know what the chowderheads called themselves, but it's up in Boston. I don't know, Silicon Lobster. I don't know.
Let's just go with that. I think Silicon Lobster works. We'll stick with that one. I didn't realize it was number 5. That's fantastic. What got the ball rolling I know you mentioned the great financial crisis and people taking that may have taken stability for granted came out and said, it's not so stable no more. But what else? What else is necessary to start to build an ecosystem?
Well, I think you need talent first and foremost, as we talked
Yep.
about, right? And then you need mentorship of that talent. So here, Techstars got started here, I think in 2008 up in Boulder. That was a really great catalyst, right? It was their system of incubation brings mentors to bear. So they kind of aggregated all the mentorship knowledge here in the Denver Boulder area at the time, brought those to help that group of companies form. And then you had capital as well. And so Foundry Group, I think, was getting started a little bit before then in Boulder 2007. So those are two of the catalysts for this ecosystem. Obviously, things have changed a lot where when I moved out here, when Josh moved out here, Boulder was really the epicenter of the local market. It wasn't even close. Boulder's continued to grow, but now Denver has kind of asserted its rightful place as the sun with Boulder as the earth, orbiting relative to population sizes, as I think a lot of that millennial sensibility of, hey, I want to live in a cool city, and Boulder started getting a little too expensive and a little too removed from some of the urban benefits and culture that people wanted.
I'll build on a couple things that Adam just said. Denver emerged as the center of that ecosystem, I would say in 2011, 2012 timeframe, as the companies that were growing up in Boulder realized that they couldn't scale the way that they wanted to in a town the size of Boulder. Boulder's a wonderful place on a bunch of dimensions, but needed a lot more people. And the secret superhero, from my perspective, in the Denver, Boulder, Colorado story, enabling so many people to come together and to see the growth that we've had, I think are organizations like Vail Resorts that get no direct credit and probably shouldn't get direct credit, but I do think deserve secondary credit for the fact that lots of people moved here or moved to Colorado because they had visited and recognized that it was a great place to be. And why did they do that? Well, there was a self-interested, profit-motivated organization that had been marketing the crap out of it for a generation and had brought people to town. And so when millennials were thinking about new places to locate to, Colorado was on the map.
It feels like a little bit of the opposite of what I saw at least happen in the Bay Area. When I moved to San Francisco in the mid 2000s, Silicon Valley was down south. It was the valley. It was down south. And then people wanted to live in San Francisco. And so it started to transfer up. I think it's actually transferring back now is what it feels like, at least when I go there. But it feels like it's a little bit of the opposite. I love that.
You're seeing the same thing here in terms of people spreading out in the suburbs, even around Denver. And a lot of people who are, working at tech companies who, way too cool to go live in a suburb of Denver a few years ago now, are there.
Yeah. So I'm going to go back to the operator component of this. I mentioned in the intros that you were both operators before, companies of various sizes. Why did you move from operating into investing?
Yeah, I'll start. I'll start first with the things I was wanting to avoid, and then the things that I was really looking forward to doing. So, first for me, I never wanted to manage a team again. It's been I love mentoring people. I love working as part of a team, but a lot of the HR dynamics that have gotten, I think, more and more difficult for companies over the last few years, both myself and my partner, who's also a former founder operator, really looked at each other and said, if we never had to do another formal performance review again in our lives, that wouldn't be a bad thing. So that was a starting point. But also and I think the consulting background, and I think Josh can relate to this, people that go into consulting early in their careers, one of the appeals of that is, hey, you get to learn about a lot of stuff, right? If you're an intellectually curious person and you'd rather be a mile wide and inch deep versus the opposite and know just enough about everything to be dangerous, that's the kind of career you go into. That's me. That's me. I love learning a little bit about a lot of things. And then, having my skill set that I think I can enable people who are what I almost look at as celebrities are people who look at a blank page and say, I'm going to change a whole industry. I've got this crazy idea, right? An entrepreneur. And I say, I've got a skill set to help that person do what they're doing better. It really is a labor of love for myself and my partner doing that.
And Josh, what about you?
For me, personal too, on a bunch of dimensions. I think probably the biggest catalyst is that I love being an operator, but being an operator is hard. And at least the way that I've known how to do it, and this is certainly a flaw of my own, is to do it fully immersively hard all the time. And that was becoming challenging for my family life. And so I thought, do I want to jump back in and do this again the only way I know how? or do I want to reallocate, spend more time with I had a young daughter at the time, now 15, and wanted to be able to spend more time with her and with my wife, while at the same time still finding ways to take the bumps and bruises that I'd accumulated along the way that maybe would be worth something to somebody, and contribute those back into the community, but do so through a different lens.
And how has being an operator, how have those roots helped or hurt the transition into investing? Adam, I'd love to start with you.
Yeah, I think it's a dramatic advantage for us versus other venture capital funds, especially at the early stage. Part of why we did this, actually, we looked around in Denver Boulder area, and there's some other great investors that we're friends with, but none of them had actually kind of been there and done that at scale. And I think we found that entrepreneurs at the early stages especially really valued people who had been in their shoes directly, right? Not just from observing it from afar, but actually had lived it. And really that empathy, I think, is something that it's really hard to manufacture. And so that's been the biggest piece there. I think something I miss, though, is a little bit of when you're an operator and you're part of a team, it's that camaraderie, right? And the highs and lows are so extreme, but if you're riding them with other great people, those highs, there's nothing like it. And those lows, right, you're in company with your compatriots. And so that's something that I miss, but I think that for us, the trade-offs are well worth it.
Just to jump in for one moment, a picture that came into my mind when you were talking was I was going through my photo albums on my phone maybe about a month ago, and I came across this picture at a former company, and we're all in the kitchen of our office and we're all celebrating. And I remember that moment vividly. And then I looked at the timestamp and it was 2:30 a.m. I don't think I remembered it being at 2:30, but I remember this exact moment. And so, Josh, when you were talking earlier about being all in it, and Adam, when you mentioned the empathy, that's a different world that like a lot of people may not fully understand of what it means to have that kind of a high at a point where most people is sleeping.
I think I would just echo all of the things that Adam said. I think the empathy thing is the most important thing. Just understanding that building an organization at any stage is hard. And the things that you need to do that well are not just the like most obvious mechanical things, but there's so many human things that are really a huge big part of it. And having empathy for and support for entrepreneurs navigating that journey, I think, is a really important element, and hopefully a place where I can be differentially contributive.
And before you get to contribution, how does it help you? You mentioned it's an advantage, Adam. Either one of you can start, but you mentioned it was an advantage, Adam. How does it help you with diligence? How do you think about the companies that you invested in a different way because you operated before?
That's a great question. I don't know that it necessarily gives us the operating gives us an advantage in diligence versus other VCs who have maybe studied things from an intellectual level. I think, I'd like to think we're, as good as, if not better than anyone there, but I don't think because we've operated, we certainly know things and how hard things are to do that other people might not see. Oh, that doesn't sound that hard. I'll actually give you one example. Okay. One thing that a lot of other VCs and even founders will hang their hat on and get really excited about is, hey, we've got this potential distribution partnership with this other brand, right? Hey, it's going to explode. They're going to promote our product, and that's going to be our ticket to giant volume. Well, both my partner Chris and I have personally experienced and done many, many distribution partnerships, and literally, I think 99% fail to meet the expectations of the partners going in terms of the volume it's going to create. So that's one example where we're diligencing and we're like, you know what, we're not going to put a ton of stock in that distribution partnership where somebody else might.
Yeah, I would echo that. And I think what I would say just broadly is like the visceral experience of having been in it comes to life and makes the elements of the diligence experience become much more vivid, right? So it's like the thing that is a struggle or a potential struggle for your business, I know firsthand how much of a struggle that can be because I've tried to fight through that challenge before directly. And so while you appropriately, as a founder, may be dismissive of that challenge today, you need to be a little over optimistic at the beginning because otherwise you would never get going with this thing. I can look ahead a bit for you and be like, okay, that's going to be hard, not unovercomable hard, but hard. Are you prepared for when you realize you have a moment where like, holy crap, that is way harder than I thought it was going to be? What are you going to be able to do to fight your way through that?
I'm going to oversimplify the crap out of this for a moment. But when you were talking about the distribution partnership, and Josh, you were just talking about barriers, I would think that there is an advantage to seeing what the potential phases or S curves are. The reason I'm saying it's simplification is because you never really know what the future is going to look like. But
Sure.
you could say that distribution partnership is actually, I'm going to put a lot of weight in it for the next year, maybe, or something. Like you could ride that wave, but then what happens after you get through that wave? Does this company, does this team have what it takes to then create the next S curve or whatever? I'm using S curve a little bit loosely there.
Yeah.
Does that come into fruition, or was my simplification too simple?
No, I think your simplification is great. Now, I'll simplify it a little bit further, which is to me, it really comes down to the individuals who are driving the thing forward.
Yep.
Can the founders or that early team that they've assembled around them overcome the known and unknown challenges that are ahead of them? We don't always know what those things are going to be, but we know that they're going to be hard. And the question is, are they strong-willed enough? Are they curious enough? Do they approach things with rigor from a data perspective, et cetera, that gives them a chance to overcome those challenges when they come up?
Where I want to go next is where I'd like to spend a good amount of time, if y'all are down for it. I am not a VC or angel investor. I have done some angel investing, but it's really like a friend comes and I give them money. It's more what it is. But I'm a public stock market investor. So my experience around VC and angel outside of being in companies that have been VC funded is really through reading. And what I've been reading recently, and especially there's this Wall Street Journal piece that came out, gives me a little bit of a sense that right now it feels like it's easy to raise and hard to exit. I would love to know, how are things really out there? What's easy? What's hard? Did I summarize that in a way that resonates or not?
I would say from my perspective right now, it's actually hard to raise and hard to exit, and hard to raise because it's hard to exit. I think it's easy to raise for a very, very small subset of companies right now that are considered the hottest, most cutting edge AI companies. Okay. And those are the big headlines you read about with like eye-popping valuations. And so I think that leads the perception that it's easy to raise. For the other 99% of companies, I think it's actually not like insanely difficult, like 2001 or something, but not easy. Certainly not like 2021 or the few years but before that. And the reason that's difficult is because there's been no liquidity. If you look at and we can talk about dive into the specifics there, and kind of no IPOs and no and limited M&A, that's created very little liquidity for the big LPs that write checks into the VC funds. And actually, the amount of VC capital raised this year is at something like the lowest level in over 10 or 12 or 14 years. I can't remember the specific numbers, but that then filters down into the amount of money that can then get deployed and how hard it is for founders to raise. So yeah, that article doesn't really resonate with me, except for the part about being difficult to exit.
That's helpful to know. To give you one fact from the article, it said last year, or something the article said, let me not call it a fact just in case, but it's what the article says. Last year, U.S. venture firms returned $26 billion worth of shares back to their investors, the lowest amount since 2011, according to PitchBook. Another piece, the decline is particularly notable because the past 3 years have been the highest three on record for total VC firm investment since 1998, which is as far back as PitchBook data goes. So a couple points to bring part of what you're saying home.
So I think really quick, what you're seeing are these huge mega rounds into these AI companies that are requiring lots and lots of CapEx to buy GPUs, right? So OpenAI, Anthropic, Perplexity, for example, these are like rounds raising billions of dollars, and they're just buying hardware. And so in fact, it kind of makes my point, which is you've got this finite amount of capital, a disproportionate amount are going into these handful of AI startups, which leaves a lot less for everyone else.
So a little over 20 years ago, more than that, way over that, 30 years ago, when companies were raising money, they were raising it for hardware. A lot of the money, it wasn't just hardware, but a lot of it had to go into hardware because you had to have your own data system, et cetera, or data center, I mean. Then AWS comes along, 15-ish years ago or so. The cloud came along 20 years ago, 15 years ago. And so then that went out of favor. Now it seems like we're raising money to go back into hardware. Not trying to predict the future, but I cannot see a world where this doesn't look silly to whomever is starting a company 3 years from now and is saying, thank you, thanks for building the pipes. Does that seem wrong?
This is certainly a bubbles are beneficial in the long term
To
adjacent
someone.
topic, right? Yeah, exactly. I mean, I think like just as you said, I don't think the world will hate having all this infrastructure having been created. I think some of the companies that are doing the creating won't be around to be telling that story, but that's okay.
And Adam, I'm imagining you still have money in whatever fund you've raised last. And so you said that for a small number of organizations that are in AI, it's easier to raise. Are you just sitting on your pile of cash like Scrooge McDuck waiting for this phase to go away, or how are you thinking about deploying capital?
No, we're really excited to be deploying capital right now. We're in our second fund and very actively investing, and feel like we're getting pretty reasonable or more attractive prices for all the companies that aren't doing these super cutting edge AI model building. AI application companies in particular, we're super excited about. And so like AI has unlocked the ability for a new class of software and business problem solving that didn't exist before. An example I can give you for a company that's really done well so far is a company in Denver here called Magic School, and they've created an AI co-pilot for teachers and students. And if you think about it, it's kind of interesting. Why doesn't a product like that exist? Somebody could have built a custom, very heavy, co-pilot for teachers. If 5 years ago, 8 years ago, they said, "Hey, I need to go raise $50 million to go build this thing, and then we'll see if we can sell it to teachers." Nobody would ever fund that idea. But now, right, with the models that are super cheap to go tap into, you can go start that thing on a shoestring, go prove that there's a market for it, and then go build and scale. And there's a bunch of other applications like that we're investing into, and others are that we're super excited about.
And Josh, what are you seeing out there? What kind of deal flow is coming your way?
So this is just a hobby for me. So like I defer hugely to Adam. I have no consequential sample size. But what I will say is from afar, it feels to me like we are in what I've been calling like the power law era, where we have taken a belief that venture returns are driven by power law to the nth at this point. And funds are recognizing that the way that they can be relevant is making sure that they themselves are on the positive end of that power law and really have outsized performance. And their path to outsized performance is to find the one or two or three gigantic successes and piling into those. And I think the result of that is that there's a lot of great companies that struggle, as Adam was saying a moment ago, to raise capital because they are not in the like far outreaches of that power law distribution, but are still building excellent businesses. And I think venture funds can build excellent returns for their LPs investing in those kinds of businesses that aren't at the nth degree of that distribution.
The one thing to note too is there's a related trend in that the number of venture funds and like the dollars going into venture have actually become much more concentrated too in a handful of firms that have built bigger and bigger and bigger firms, right? You look last year, I can't remember all the funds, but Andreessen Horowitz, Thrive Capital, I think General Catalyst all raised many, many billions of dollars. And those are the ones that are piling money into these handful of very CapEx intensive AI startups. The rest of the industry, right, that are now the funds are harder and harder to come by for funds, smaller funds like us and all of our colleagues, and for companies that we're funding. But to Josh's point, at least, maybe we're talking our own book, but we genuinely believe that there's a huge set of opportunities there that are, kind of not in the hottest of the hot areas.
And Andreessen partially raised billions of dollars to buy GPUs. They've bought GPUs, and then when they go to invest in companies, they're like, "Oh, well, we actually have the GPUs that you can't get because of supply constraints. But if you let us invest in you, dot, dot, dot."
But I don't think as they were buying those, they said we're going to forego management fees on the dollars we're collecting that we're going to use to go buy hardware, right? So like
You don't think
every
so?
extra dollar that they spend to buy hardware, they still get consequential management fees. Huh?
We could go into the structure of VC, but I don't want to hurt your tax bottom line, Adam. Josh, I'm going to not let you off the hook for a moment here. I have heard you historically say things that are hobbies for you, but you still do them very well. Generally, your hobbies are you will not take that well because you don't like compliments. However,
All right.
I'm going to push a little bit further here, and I want to go back to what you were mentioning around the teams being very important. So even as you're looking at your quote unquote hobbies, right, that are coming your way and you're seeing deal flow, how do you analyze? This is something I've seen you do very well. How do you analyze the human beings and their ability to be able to execute? I'd love to go 1 or 2 levels deeper into what you look for.
Yeah. So I'd say there's a couple of things that are most intriguing to me on that dimension, and my perspective is always improving and evolving for sure. I alluded to some of this before. So the first couple that I'll say are resilience and the ability to like process data of all kinds in complicated, difficult circumstances to help overcome problems. Because we don't know what's going to be ahead, but we know it's more complicated than the forecast that you've created at time zero when you're creating your thing. Inevitably, a bump is going to come in the road, and how you navigate that bump and the set of bumps that'll follow is like the whole thing. I think the third element is the one that's like most intriguing to me and most complicated for me. And Adam and I separately have talked about this a bunch. I'm intrigued to get his perspective on it. And that is there's a unique group of individuals who have one reason or another why what they want to build is a exceptionally big, exceptionally successful company, to the point where along the way, they may well have opportunities to sell their company for lots of money, but they want to pass on those because they want to keep building. We shared around before this Buffett Munger clip where they talk about loving money or loving the business. And one view of these people is that they like truly love the business because they're making decisions that are for their own well-being, probably irrational about the money, right? So like to me, if you have an opportunity to sell your company and make $100 million, you should probably rationally take that opportunity every single time because you don't need $100 million. That's like way more than you could ever need. But people regularly pass on that who fit into this like odd special group. Sometimes those people are complicated to spend a lot of time with as individuals, but those people also are often the people that drive really outsized returns for technology company investors. So that's the one that's like most complicated for me personally, emotionally, to figure out where I come out on is that dimension.
Yeah, I think two things to piggyback on what Josh is saying. I mean, I don't know if it's a true or just apocryphal story, but supposedly Don Valentine, the founder of Sequoia, told another Sequoia partner, showed him a graph of 2x2 genius and how insufferable you are, and said, pointed to the upper right hand quadrant. So this is where we make all our money, right? On insufferable geniuses. And I think, another a similar point was talking to another experienced VC. Every time I talk to other experienced VCs, I ask them, what's your biggest lesson? And one of them told me, I thought early in my career I would judge founders by like, oh, do I like this person? Do I want to have a beer with them? And he said, I pretty quickly realized that's a terrible test. That's irrelevant.
So if I want to have a beer with you, I should not invest.
It's irrelevant. It's irrelevant.
Okay, either way. Okay.
Either way. Like that's just not a relevant consideration. And particularly as humans, we like to invest in people and spend time with people that we like, that we just emotionally and tangibly like. And I think removing that factor, certainly judging someone's ethics, if someone's honest, that's important. But do I just like them? Do they seem like a person I want to go hang out with? That's not really relevant and proportionate to like whether or not they're going to be ultimately this special type of person that Josh mentions to drive the outsized returns in VC.
And going back to the $100 million offer that you turned down, that does feel like a special kind of person. And it also seems like that person is being fueled today or encouraged to do so by secondaries. And so I'm looking at a graph right now that I saw Bill Gurley shared around on the Twitters or whatever it's called these days, who knows. And it's looking at over the past couple years, the difference between money that has come from tech IPOs and money that has been spent on secondaries. Secondaries, for those that are not familiar, that's when investors put money into a company and it goes to prior shareholders. So their shareholders are able to take money off the table. So if someone says, I'm going to buy you for $100 million, and let's say you own, I don't know, 20% of that as a CEO founder, and you could take $20 million off. If you've already taken $5 million off, you might be like, actually, the difference between 5 and 20 isn't that high. Ride or die, baby. So that's how it's also being fueled. I'm curious what you think about the size of secondaries right now and what that has done or may do to the market.
No,
Yeah.
really good question. It's caused a big change, and I think has contributed to what we've seen in terms of the amount of money that's locked up in companies not going public, right? I've asked everybody I can. This is the topic du jour in all private equity right now, is the lack of IPOs, the lack of liquidity. And I've asked everybody, why do you think this is? And nobody has a really good answer. It's regulation. No, regulation hasn't really changed since companies were going public, 10 years ago. Dodd-Frank was already in effect, and Sarbanes-Oxley, these things, nothing's changed there. So what's changed? And I think the secondary and these larger funds that have allowed companies to be private for longer, excuse me, you don't have to go public as a founder to get liquidity is what's really dramatically changed it. But the music's got to stop at some point, right? I mean, you could, if you're an investor, you can sell to the next person up the food chain who's willing to write a bigger check for only so long. And then you get stuff like Stripe and Databricks that are private companies worth, 50 billion plus. How are they they got to get liquidity at some point. And the only place for them to do it is the public markets historically.
I've been a student of again, I'm a public stock market investor. I've been a student of public markets for a long time. I spend way too much time in public stock market data. It is unhealthy. Do not do it, but I love it and I'll do it forever. And one thing that has, going to your point around why aren't companies going public, one thing that stood out to me when I'm having conversations with folks is they'll use some version of the phrase, well, we can't go public because of something inside their business, because of the market. And I'm thinking back to all the companies that I've studied that have gone public. Any company can go public. I'm not saying any company should, but it's not necessarily because of the timing or any of that. It's just because like that, you're not a public company. Like some businesses should not be fueled by public dollars. But there's something, it seems like, that's in the water, that there's this prototypical public company that you have to be in order to be out there, as opposed to the way I would think about it. Like if I'm investing in a public company, I'm thinking about compounding over a number of years. And so if you go public at a time where your stock drops, I'm like, cool, I'm holding it for a while. So like that it's not a factor for me. So I get very surprised by the idea that there's some ideal public company that exists.
I don't think there is, but I think what you're alluding to is a huge part of the story, which is it's a real different level of pain in the butt to run a public company because of the public scoreboard. Your stock price is moving up and down every day, often in wild ways that are irrationally disconnected from the today goings on of your business. None of that has to be visible to everybody on the team if you're a private company. And it just adds a whole layer of additional complexity that you can avoid by staying a private company longer. And I candidly, and we've all talked about this a little bit, I think about it from the flip side as an investor. I am both a public market investor to some degree, but probably more so a private market investor. And part of the reason why I have a disproportionate amount of dollars in private market investments is knowing the shortcomings of my own psyche. I don't like looking at the scoreboard. And so being able to have money that compounds in great companies that build value, where I have little or no opportunity to get liquidity from them as a result of something exciting or something scary or something irrational that's happening this week, is in some regard a challenge for a lot of people, but for me is a feature that I'm drawn to. And it I think helps me be more patient because I have no choice but to be patient.
I love looking at the scoreboard. I love the scoreboard. It drives me. Psychology's everything.
You are able to be a more disciplined and better human than me. I love looking at the scoreboard, and I recognize that my behavior when I look at the scoreboard is not something that the next day I'm necessarily thrilled about having done.
Okay, that's perfectly fair. That's fair.
I'm with Josh 100%. 100%. I think one of the things that underlies all this too, and I'm with you, Doogles. It drives me nuts, this idea that everybody says, we can't go public, and I say why, and nobody has a real answer. Well, we just can't. We just can't. No, the market won't accept it. And why this sentiment has changed, the animal spirits have changed, so that if you were a company, I remember there was a company in Denver called SendGrid, I think was doing 75, 80 million ARR, had what was considered a great IPO at the time. And now that would be laughed at as a potential IPO, 80 million ARR. No, you got to be 400 million or 500 million. Why? There's no real reason. I think what has happened though is the small cap, large cap. This is the best answer I've heard from somebody. It was actually a public market investor. the small cap, large cap divide, which is historically wide in terms of valuations. And like everyone's been piling into the Magnificent Seven and maybe it's 10 companies now. And everyone has been trashing the small caps. I think I heard a stat that in the last 2 years, the S&P 500 that we all talk about, the market's ripping, it's up 40, 50%. The Russell 2000, which is all the small caps, I think is only up a couple percent. And if you're going public and you're a company worth $1 billion or $2 billion, you're a small cap. And you're at risk of not getting analyst coverage. If you miss a quarter or two, you're now thrown in the trash heap with everyone else that's been suffering for 10, 20 years as a small cap. And I think that is maybe what's happening. And that needs to change for people to decide to go public.
Yeah, a moment that, or maybe I'll just say a company overall, but a moment in their history that I just love. So I'll bring up any opportunity I can. Progressive Corporation, the insurance company, you know them by Flo. Beautiful company, very well run for decades, and had an amazing stock, still might. I haven't followed it in a little while. About 24 years ago, it was around the turn of the century, there was a point where they were just getting hammered by analysts because they wouldn't disclose to analysts. They weren't like doing the backroom shuffle where they would tell analysts like what was going on. And they just said, no, like, we're not going to do this. But they went, look, if you want more information, we'll give it to you. And so they just started reporting their financials monthly. They went, if you want more info, we'll just do that. And that to me, I was like, that's amazing. There's not very many people that can go, not only will I put myself on public display, but I will do it on a more frequent basis. And I don't feel like that kind of gumption exists now. It's like a bunch of people are afraid. I'm using the word afraid to put my own words with them. They're like afraid to be out there. That's what it seems like to me.
I think you're right. And it's not good for you as a public investor. I think
no.
There's 40% less companies than there were 25 to invest in, and that number is going to keep shrinking unless unless we see a regime change here.
Yeah, it's awful. I got into a battle. It was not a battle. I was the gnat in this, and then the fly swatter came out immediately. But I got into a battle with Mark Andreessen on Twitter about, I don't know, 12 years ago or so. It was a little while. My general statement, as someone that's a public stock market investor, I said companies are waiting. Maybe it was more like a decade ago. I feel like companies are waiting too long. They're getting too big before they go public, even at that point in time, such that by the time they go public, I cannot get all the, like, I can't ride the $300 million company.
I think this ties into what Adam was saying, right? Like what you're saying is that a lot of the growth has been squeezed out of companies before they go public, which is where I think you end up with these outsized investor interests in the Magnificent 7 or 10 or whatever, because there are a handful of companies in the public markets that are still driving a ton of growth. Those companies, as a result, attract an absurd amount of public market investor interest in a very disproportionate way to everybody else.
So now I'm going to ride this. I like that we had that. It's a perfect transition. I'd like to talk about the future. If folks want to be able to ride more of that wave earlier, then more people would need to be able to invest in companies when they're earlier stage if they're not going to go public till later. So you've gotten these organizations like AngelList has touched on this, Republic, Fundrise. You have these companies that I'll call it maybe not the average everyday person, but more like the average everyday person is able to go in and buy these smaller organizations. Is this good? Is this bad? Where do you think it goes based on what you all have seen?
It's a great question. I think overall it's a good thing, although I think that the democratization of this is better. I think the accredited investor rules, if folks aren't familiar with it, you've got to be an accredited investor and have a certain amount of wealth and income to invest in a private asset. It's kind of ridiculous. So someone needs to have a certain amount of income or wealth that suggests they know what they're doing or can afford to lose it to invest in my fund, which is a professionally run VC fund, a real estate asset, an apartment building that is historically a lower risk type investment. They can't do that, but they can go throw all their money in Robinhood and YOLO out of the money call trades all day long, right? Makes no freaking sense. So as long as that exists.
Or if you're simply a dentist, then you're very well qualified to invest in early stage tech companies, right?
That too.
So right. Yeah.
That too. The one thing I would say though is I do think that in the private markets where there's not all the disclosures, there's not all the data, which is one of the features we like about it and why we think, if you're uniquely advantaged within some part of the private market, you can have an advantage because it's opaque and it's not perfectly efficient like the public market is. The downside of that is we see the companies that go on these crowdfunding platforms today, it is very much the adverse selection dynamic, where it's all the companies who have not been able to get funded by professionals go there as a last resort, go to the public. And hey, you might be able to find a needle in a haystack. It's possible. But I think that's where people don't really appreciate, individuals appreciate how the amount of adverse selection in every aspect of private markets, whether it be VC or real estate or private equity.
Yeah, I came across these venture capital trusts in the UK, which from the little bit that I was able to find on them, it seems like these are publicly traded holding companies, not quite like the SPAC in the US, but it's like as if a Range Ventures could be public. And then I'm effectively investing with you, similar to what like AngelList allowed folks to do, except it's in a public traded asset. I think something like that feels more interesting to me than to your adverse selection point. I've gone onto some of these websites, and one, it's not the game I play. I have no edge on these websites. I'm not sure anyone does, but I certainly don't have any edge on these websites. But I go on them and I'm like, really? Ugh. Maybe, like that's kind of like that's all. And then I close the browser, and then every 6 months I go back in there. It doesn't seem like the platform that's going to actually solve the issue that you named before, Adam.
Yeah, and I think the trick to this though too is if you are determined, hey, I'm going to go invest in this, I'm going to go on this platform, you're now judging the deals you see only within the four walls of that platform and which ones are good and bad within that. You're not seeing all the deals outside of that platform to compare it to. And I think that's what we see all the time. We actually see, Doogles, we see a lot of times a really successful person who's very smart, exited a business, has a lot of money and says, hey, people come to me and they ask me, I can be a Shark Tank judge. And, they look at the deals they see and judge within those and don't realize we talk to these folks all the time when we're trying to raise money for our fund. And they tell us the companies they're in, and they're inevitably all the companies that all the professionals had passed on. And they didn't realize.
All right. Where I'd like to close out is I'd like to get a sense for how you all, outside of the investing we've talked about here, how you invest your personal dollars. If you're down for that, I'd love to get to that. Before we get to that, you mentioned the Magnificent Seven. And if we just go to the Magnificent One, I want to sit on this for a moment, because even if we are in a bubble, let's say we're in a bubble that's about to pop and it's all going to crap, even then, this company, it's not like the companies of yore where there was at least, I don't know, 60% vaporware and hope and a dream. This company, NVIDIA is the name of the company. This company has more profit now than it had revenue a year ago. What is happening, and what does the world do when there's a company of its size that is able to do that?
I mean, it's amazing. Let's just start there. It's just like such an unbelievable growth story. I think it will dovetail into somewhat of what I'll inevitably say when we talk about how do I personally invest. NVIDIA to me is like the canonical company that like I would suck at investing in the public markets because at any given moment, shout out to Skippy, along the course of the past few years, you've been able to easily say this company is massively overvalued relative to where they are, and you should totally get out of it. And by the way, if you had, you would have like missed, the next 3 doublings that happened in this company, or 10 or 20. And I think it is just like a unique, complicated challenge. Now, on the flip side, I also do believe that at some point, maybe the music stops here. And I always do worry about the people who are the last holders under that circumstance.
I completely agree with Josh. It's just amazing to watch, right? I have no opinion on whether NVIDIA is a buy or sell here. The beauty of capitalism to date, and I don't think this is going to stop, is that when someone's got incredible margins like NVIDIA does, there's a lot of people gunning for that, right? And ultimately they will develop some competing products that will, create margin erosion for NVIDIA. And that's where NVIDIA's stock will get hit. I don't know if that's a month from now or 20 years from now. But I also think and I'll go into my personal investing too. This is kind of the case for index funds too. There are very few people who saw this one coming, right? The returns for any index concentrate in a few stocks, and NVIDIA is one of them in the S&P or the broader US stock market. If you were investing in NVIDIA 25 years ago as kind of a gaming chip company, and there's a million times where it looked like that thing was dead or it wasn't working or, AMD was kicking their ass or whatever, there's no way you saw this AI wave coming that they were going to double a million times. And so you got to be invested in the whole basket of companies to get the one.
I was talking to a founder maybe about 3 weeks ago, and they mentioned around a decade ago or decade or so ago, they started a company. It was too early. Like it was a good product, good company. It was too early. It ended up getting bought for, not a high multiple, but it's fine. And then they said, and then we started this company in, I think it was 2020, started a company, and it was a company for being able to take large language models and making artificial data sets out of them. And he's like, am I going to be early again? We'll see. But, we're building and it's going to be great. Then he goes, and then ChatGPT launched. And I'm a genius. Right. And he was saying it like not in a very sarcastic way. He goes, I started two companies, both of them solid products, everything, but like, how brilliant do I look? And I'm like, am not that brilliant from a timing perspective. But sometimes you just hit luck. And if you can invest in all of them, to your point, right, that's very different because then you invest in NVIDIA. If you have the whole index, you invest in NVIDIA. Okay, personal investing. What do you all do for your own money?
So it starts from recognizing that I am not super good at this by any means, and I am subject to my own emotional volatility and concern about protecting the scarce resources that I have available to me. And so, while I've done many stupid things over time, the like one smart thing that I've done has protected me from doing more stupid things, which is I think about the dollars I have available to invest in three different time horizons: 0 to 2 years, 2 to 15 years, and 15 years plus. And it helps me not be so concerned about the liquidity or day-to-day volatility of the stuff that's in either of the latter two buckets, and therefore lets me make more rational long-term investment decisions in those buckets. Well, in the 0 to 2 bucket, it causes me to be quite conservative. So, I hold a lot of treasuries presently in the 0 to 2 bucket. And in the 2 to 15 bucket, it's a mix of Berkshire Hathaway and index funds. And in the 15 plus bucket, it's a lot of illiquid private company real estate kinds of things where I look at the illiquidity as a feature for that bucket, not a bug, because I can't do something irrational. I am protected because I don't have my hands on the wheel from doing something irrational for the money that is intended to try to grow over the long term.
Josh, be 100% honest with me. Are you Warren Buffett?
I
Because you
am
just said
0% Warren Buffett.
you just said
0%.
what I heard you say was I own a bunch of treasuries and a bunch of Berkshire Hathaway. And that sounds like Warren Buffett. Mine is the private stuff.
Part of why I own a bunch of Berkshire Hathaway is because Warren Buffett owns a lot of treasuries. And so I like the fact that they have the capability to, when they see things that are priced appropriately from their perspective, and they are way smarter about all this than me, they have the flexibility to make purchase decisions. And then when they do, they can hold those things for a long time and benefit from the compounding. And I'm abstracted away from having to ride the emotional roller coaster and make rational decisions throughout both the ups and the downs of that roller coaster. I just let them do it, and they seem to be pretty good at it.
Love it. Adam, what about you? How do you invest?
So very similar to Josh. I think of three buckets the same way, and I'll go through each bucket. So near term, it's treasuries, it's money market accounts. The midterm bucket, it's stocks and bonds index funds, right? Very diversified. It's across U.S., international, small cap, and then bonds as well, which obviously is underperformed S&P 500, right? When you're fully diversified international and small cap as well, it's underperformed. But I think that's the don't plan on selling, and it's just a rebalance exercise. The only free lunch you can get is rebalancing and tax loss harvesting, at least historically. So I believe that. In the illiquid bucket, and like Josh, that's why you're having us on, have a disproportionate amount of money in the illiquid bucket relative to what a financial advisor would tell you. And I look at that bucket really through the lens of avoiding adverse selection, as I mentioned before. And so there's kind of two groups in that bucket. One is my own, what I'm doing myself, right? And I can control it. I feel like I've got an advantage. I'm putting my money where my mouth is, and I have a lot of my own capital in what we're doing at Range. But then outside of Range It's things that it's investing in people that I believe are an expert in what they're doing and are better than me at making that decision, whether it be real estate, private equity, other venture investors. And it's, again, the adverse selection, asking, why do I have the opportunity? Why am I so lucky to get to invest in this real estate opportunity or this fund, right? And usually the answer to that is it's somebody that I know really, really well, and they're relatively early-ish in their career, at least the stage I'm at, relatively early-ish in their career, and I'm making a bet on them to prove it and make it happen because of the experience I have and trust I have in this person. I think that's what I look at, and I think is what makes it really enjoyable too, to kind of support other people's careers in that bucket as well.
Hold on to that international. I just did my most recent individual outside of my model, most recent individual stock analyzing, and whew, oh my goodness, international is looking so good. I may be
small caps international. You know, the most bullish thing I'm going to tell you on small caps, because there's a million reasons why this time is different, right? The mega caps are going to keep compounding. They've got every advantage, and it all makes sense. Is I talked to a small cap mutual fund manager who's been doing this for 30 years and managing billions of dollars. And this guy was you've seen that chart, right? Of the exhalation, the panic, you know, and then the very bottom, you throw in the towel. That's where he's at right now, right? And he's like, I've seen every cycle. I give up, and I'm like, ooh, that's the most bullish thing I've ever heard. Yeah, exactly. The other thing I do want to say, Doogles, too, is if you notice, there's one bucket of assets that neither Josh nor I own, and we can talk about this, and that is what I would call collectibles. Okay, I put crypto into that bucket. And I think, and I put crypto, people ask me my opinion on crypto. I'm a VC, I must have an opinion. And I said, I don't have an opinion on Bitcoin, just like I don't have an opinion on baseball cards, fine wines, or paintings, Picasso's. It could be the best investment of our entire lifetime. I have no idea. But I think in terms of, and I think you do the same as a public, I think in terms of productive assets, I'm going to bet on you, on Josh, on someone else waking up every day as a smart person thinking, how can I, make money? How can I earn a living for my family and make my place in the world versus, hey, I think there's someone else who's going to think that Picasso is more valuable than the person did last year. There's other people who are really good at that. I'm not.
Same. And I love thinking about crypto as a collectible.
Oh, it'll really piss off somebody. It'll piss off somebody who's in, but I'm not anti-crypto. It's a collectible as far as I'm concerned. You're selling the exact same thing to someone else for hopefully a higher amount of money.
I bought $10 of crypto 3 years ago. It is now $2 worth of crypto, and I think I'm good. Like I think I've had all the crypto adventures I need. Thank you so much, both of you, for being on. Love your experience. Love your perspectives. This was a lot of fun, and appreciate you.
Thank you,
Likewise.
Douglas.
Thanks for doing this.
Yeah, of course. Thanks for joining, everybody. As always, skippydoogles.com is where you can go for all your Skippy and Doogles talk investing needs. We got the Substack that comes out, skippydoogles.substack.com, and see you next week.